We're now going to look at our final chapter in Accounting 112, Chapter 17, Analysis of Financial Statements. So everything you have done over the past 2 semesters in Accounting 111 and Accounting 112 helped us to reach this chapter, which for the majority of you, this is why you took the course, to learn all about that information so you can properly analyze financial statements. Most of you aren't going to be accountants, and even accountants do this all the time. But for business professionals, you will be analyzing financial statements. So let's take a look at what we're talking about here. These are our concepts and our procedures. So basically, we're going to explain the purpose and the tools and building blocks for doing financial statement analysis. We're going to describe standards for comparisons when we're doing this analysis. We're going to summarize and report results of analysis. And the procedural part will show us how to use the tools, something called horizontal analysis, vertical analysis, and ratio analysis. So why do we have this? What is it? Financial statement analysis? Well, it's right in front of you. The common goal of doing this exercise, for whether you're inside the company, an internal user like a manager or an officer of the company, or an internal auditor, or an external user, an owner, a shareholder, or a creditor, a lender, or a supplier, okay, is to evaluate company performance and financial health, to determine a few things. How well has the company performed in the past to the current? What is the current financial position of the company? Are they healthy or not? And what kind of future performance can we expect? And what kind of risks are involved? So that's why we do it. So you can kind of make an analogy here, and I like to try to bring it down to make it real so you can understand what exactly you're going to be doing. You're kind of like a doctor. You know, a doctor assesses your health. So think of it, when you go to a doctor, what happens? Well, they use certain tools to measure your health, like they take your temperature, they take your blood pressure, they listen to your heart, and they measure the responses using those tools, your body's responses. And then they look at benchmarks or standards for your age group, okay? And then they make an analysis of your health. We're doing the same thing, but we're doing it for the financial health of a company. And this is why. So the building blocks of analysis, what are the key things that we want to check or look at when it comes to analysis? We want to see how liquid the company is. How well can they pay current liabilities? And how efficient are they? How well do they manage the assets of the company? We're going to focus on 2 major assets when we're testing that efficiency. Solvency. How well can they pay longer term liabilities? Can they? Do they have the ability to do that? Profitability. How well do they make a profit? How well do they perform? And how well do they perform in the market? Market prospects, meaning out there where their stock is purchased and sold. So these are the items that we're really defining when we're assessing the health. Now, What do we use? Well, when you go to the doctor, they're checking you, your body, right? When you are doing financial statement analysis, you use the financial statements. So anyone who has access to the financial statements can complete these exercises we're about to look at. Look at the income statement, you'll see that, balance sheet, the statement of stockholders' equity, the statement of cash flows, and even those additional notes to the financial statements because they define a lot. So if you're like, oh, we got to read through that. Yeah, remember, even when you go to the doctor, they just don't come in and not talk to you. They just don't use tools on you and say, here's what I think. No, they talk to you a lot. So the notes to the financial statements fill in a lot of information about the financial statement. So it's very important that we read through those to get even more information about the financial statements. So that's usually what I say is the starting point. Read the annual report, the financial statements of the company. Sometimes they're 100 pages long. So this isn't just something you're going to do in 20 minutes. You're going to read through these. You want to absorb all the information before you even start the analysis of the tools that we're about to look at. But once you read through them, now you can start analyzing them and using standard tools to assess the health. And that's what we're going to be focusing on now. When we come up with numbers in these tools we're about to look at, we have to interpret what those numbers mean. It is essential to compare the results we obtained to other standards or benchmarks. For instance, if your blood pressure comes up to be 200 over 150, now in your mind right now, you want to went, wow, you're about to have a stroke. That is really high. How do you know that though? How do you know that's a high blood pressure? Because there's a benchmark or a standard that you just compared automatically in your mind. You've been told that's high because data has been collected that creates standards. So in financial statement analysis, we do the same thing. So when we're using the tools, we compute some number. We don't know if it's good or bad, if it indicates health or non-health. So we need to compare it to last year's numbers, our competition, our direct competitors' numbers, maybe industry averages. And that's key. You got to stay in your peer group because you can't go comparing yourself to other people that aren't like you in the same industry. Just like my blood pressure norm is going to be a little different than someone in their 20s because I'm a lot older. So we compare our norm or our results to norms within our peer group. And that's our competition in our industry and ourselves. Or maybe there's some kind of guideline even provided out there. But the key is we find a benchmark and we get it as close to ourselves or that benchmark as we can. Now here are the tools. So here's how we compute the numbers. The first one is called horizontal analysis. And horizontal means going across, and that's what you'll be doing here. You will be comparing financial items in our financial statements going across. Then there's vertical analysis. In vertical analysis, you're going up and down the financial statement. So you're comparing financial condition and performance to some base amount. We'll define that. And then finally, ratio analysis, which I love on page 627. There's a summary there of all the different ratios. And there's about 15 of them. We're going to take a look at them. So these are formula based. So let's start with horizontal analysis. So horizontal analysis is the review of financial statement data going across time, and it's if you go to page 616 of your book, there's an example. It's actually for Apple's balance sheet, real balance sheet there. And on the top and on the bottom is their income statement. The key to horizontal analysis is you need at least 2 years of information for that company. So in the real world, we always provide at least 2 years of financial statement information. We call them comparative financial statements because you can compare last year's numbers to this year's numbers. And that's just something we do. You'll never see a company just put 1 year's like we have been doing. So the first part of horizontal analysis is find out how the item changed dollar-wise. And you do that by taking the current analysis period, so it could be the current year, minus your base period amount. Okay, so analysis period is usually the current year. Now, if you're only trying to determine how this item changed from last year, then your base period would be last year. Once you do that and get that dollar amount changed, now create this fraction. It'll be that dollar change, whether it's positive or negative, divided by the base period, which would be last year in the case on page 616. Then multiply that by 100 to get a percentage. So if you take a look, I'm just going to grab accounts receivable here on page 616. For Apple, it went from 15,754 up to 17,874. So it increased $2,120. What's the percentage increase? We'll divide that dollar change by 15,754, 13.5%. So run through that exercise. Each one of those, that is how that is calculated. So it's going across. Go down to the income statement. Take a look at cost of sales. It increased from 131,376 last year to 141,048. So increased $9,672. How much did it increase percentage-wise? Divide the 9672 by the 131,376. So 7.4%. So it's telling us how a particular item on the financial statement changes from a base year. In our example here for Apple, the base year is last year. So there is that Apple financial statement, very small. I'm not going to go through each line, but you can. And really, if a company is able to get their financial statements into an Excel spreadsheet, which is very common, you can do these calculations very quickly with one formula and copying the formula, one or two formulas, copying them down, instant horizontal analysis complete. There's the income statement. So now you can see, oh, we can determine how much each item changed percentage-wise, which gives us a better indication of how it changed and a better tool to compare than just the dollar amount. Now, how do we use that? Well, before I go into trend analysis, we can compare our horizontal analysis results to industry averages, which companies will. There's a company, RMA, Risk Management Associates, out of Philadelphia, that they used to put out a book. I think they still do, a book of industry averages each year. But you can also buy them online. Just purchase. They do this. What they do is they take companies in an industry, calculate their horizontal analysis by line item for each company separately, and then average them together. So then you can see, how do I measure up to my industry? How did their assets, liabilities, and parts of income statement change from last year to this year? And indicate problem areas. Now, trend analysis is another type of analysis using horizontal analysis. So what you do with trend analysis is you take the dollar amount from the current period and divide it by some base period. It could be last year, it could be 2 years ago, and then multiply that by 100. And that will tell you the percentage change from that base period. So here's an example. If you have your current sales, 229, and you make your base year 4 years ago, you would take each year, so 3 years ago, 2 years ago, 1 year ago, current year. So each year's dollar amount divided by the base year. So in year 4, that's your 100% amount. Now in from 3 years ago, you're at 107. So from 4 years ago, the increase in sales was 7%. Do the same thing with 2 years. Oh, wow. Sales increased over a 2-year period, 36.7% in total. So that's not a change from year 3. That's a change from the base year. It's trending. 1 year ago, your sales overall increased 26.2%. So from 1 year to the next, okay, they decreased. They decreased almost 10%. But then they increased almost 8% because we're basing them off of 4 years ago. So it's just showing you trends. So that's another tool you can use, utilizing this horizontal analysis. So if we graph this, which is really cool, now you can see this trend. 4 years ago, here was your 100% number. Now your blue line is sales. The percentage change would be represented by the blue line. Cost of sales, and then your operating expenses. So now you're creating a picture, kind of like your tableau, right? That's showing you how these items trend over time. So you're looking for peaks, valleys, and things like that. So that's horizontal analysis. Now, the next type of analysis is vertical analysis. Vertical analysis, we determine a base amount that will always be our denominator in our fraction. On the financial statements, if you are completing vertical analysis on the balance sheet, total assets is your base amount. So you're always going to use the total asset amount for that year, because vertical's up and down. If you're completing your analysis on the income statement, you use revenues as your base amount. Then you'll take each item for that year on that financial statement and divide it by the base amount, depending on which financial statement you're looking at, times 100. So page 619 is Apple's vertical analysis. Now you see, and it's very hard to see on our slide here, but we have vertical analysis for the current year, vertical analysis for last year, because it's not going across, it's going up and down. So you're going to have 2 separate computations. In the current year, you're going to use total assets of 375,319. So you'll take your 20,289 in cash divided by total assets of 375,319, 5.4%. And you'll do that for each asset dollar amount and then divide it by total assets. You'll do that for your liabilities as well. 49,049 divided by total assets, which is also total liabilities and stockholders' equity. And you get 13.1%. Now, in the prior year's vertical analysis, you'll be using last year's total assets as your denominator, because then you want to find how much each asset was of total assets for last year. And that's where these percentages are coming from. So now we can see, and this is what it's measuring, what percentage each asset is of all the assets. So 34.3% of all the assets are current. 51.9% of all this company's assets this year are in marketable securities. Last year, same deal. And it looks like they're pretty similar. So they're keeping their assets invested in the same areas. Same with these liabilities here. So you can look at this in two different ways when it comes to liabilities and equity. Of all the assets the company owns 100%, they owe on 64.3% of them, because liabilities are 64.3% of assets. They own in stockholders' equity 35.7% of them. And it breaks down the percentage. Or you can say of liabilities and stockholders' equity, 64.3% are liabilities, 35.7% are stockholders' equity. Okay, but really I like to look at it as comparing it to the assets. Okay, this is telling us how much we owe on our assets and how much we own of the assets. That's where the money's coming from to buy these assets. 64.3% is coming from creditors, 35.7% this year are from owners. And then we could look at our numbers last year and see if anything's really different. Same with the income statement. But now when you complete vertical analysis, you use sales as your 100% number. So each item going down the income statement is divided by sales for that year. So sales is your 100% number. Take the 141,048 divided by 229,234, 61.5%. Same with gross margin. Now for last year, you're going to use the 215,639 revenue as your number, denominator number in your fraction, and then take each item as your numerator divided by 215,639. What is this telling us? It's telling us what percentage each item is of sales. Or if you want to look at it as a dollar thing, for a dollar of sales, we pay 61.5 cents for the inventory we sold. Our gross profit is 38.5 cents, or 38.5% of our sales remains as gross margin. And then what percentage of sales we pay out as expenses. And ultimately, this is called the profit margin. What percentage of sales we keep as income. You could see they're pretty similar from last year to this year, but you want to take a look at your industry as well, Apple, and see, are we in line with what other companies in our industry are doing? And that will help us identify problem areas or really good areas. So we could make what's called common size graphics. These are great Tableau things. Once we complete our analysis, make a picture of it. That tells you so much more. Look at 60. If we did this as a pie graphic, sales being 100% of the pie, 61.5% of our pie is in buying inventory. 6.9% is paying taxes, 5.1%. Okay, and you can see how we can take and define. If we made a tower pie, for our assets. So this tower or bar, if you want to call it, are all of our assets. Now take a look and see what percentage each asset is. And that picture really tells a lot of information. So that's how we can utilize vertical analysis to communicate. Okay, but it's also used to determine health. So first two tools, horizontal analysis and vertical analysis. Now we're going to get into ratio analysis. Now, the key to ratio analysis is, yes, being able to calculate the number. But what's important for you walking away from this chapter is really understanding what it tells you. So I'm going to spend some time talking about that. Remember, these are our key building blocks. So each one of these will be a category of ratio, and we'll have a couple ratios within each category to help us define the health in these different categories. So our liquidity and efficiency ratios are our first building block, our first category. So you could think of this when you go to the doctor is going to have their own categories to be able to determine your overall health. It could be blood pressure and heart rate is one category. So they're going to use different tools to measure that. That's what we're doing here. So let's take a look at each of these individually. Working capital is a number. So, working capital is the amount of current assets. So remember, what are current assets? These are assets on the balance sheet that we have available to use in the coming year. Minus current liabilities. What are current liabilities? These are the liabilities that are due in the coming year. So we're looking to see, do we have enough in current assets to pay off those current liabilities in the coming year? The difference between these two is called working capital. So the more working capital, more positive it is, suggests a stronger liquidity position. A strong liquidity position means you have the ability to pay your debts in the coming year and continue operating. Think of it. If you didn't have, if your mortgage is $1,000 and your paycheck is only $800, okay, your current assets would be 800, your mortgage is 1,000. How are you going to get that other 200 bucks? Okay, now you're like, I might have to sell something, like might have to sell my phone, a capital asset to you, or my car. That's how companies look at this too. Now, our current ratio will define us with a measurement tool. Like vertical and horizontal analysis gave us percentages. The way we calculate it is we take all of our current assets and divide it by all of our current liabilities. Now, your author likes to give that standard. This ratio measures short-term debt paying ability of the company. So, I could read that to you, but here's how I define it. For every dollar in current liabilities, the company has whatever the current ratio is in current assets to pay it. So in your book, they come up with a current ratio for this company. Where is it? Or, yes, if you look on page 622 of 128 for the current year. So what that means in my understanding of it is for every dollar of current liabilities, the company actually has $1.28 in current assets to pay them. So of course, the higher that number, it suggests the more of ability to pay current liabilities. You always compare to the industry. You always have to. Now, current ratio looks at all current assets. Now we're going to start drilling down and taking some assets out of current assets because not all of them are really liquid. So the acid test ratio, don't ask, I don't know where they get that from, but acid tester, we call it the quick ratio. We're only going to include in our numerator current assets that are really liquid, meaning they're going to be converted to cash really quickly. So cash, short-term investments, and current receivables. Those are the only current assets we'll keep in our numerator. Add those up and divide them by current liabilities. So we're taking out non-liquid current assets. They're available to use in the coming year, but they're not converted to cash as quickly as these guys are. Now, when we get this result, I'm not sure if go back. Let me explain to you what it means. So this is on page 623. Now, I think this is still Apple. Or are they doing a different company? No, they're killing me. This is Google. No, Apple's. Apple's is 0.91 to 1. What does that mean? Here's what this ratio means. For every dollar in current liabilities, the company has 91 cents in liquid assets to pay it. Now, if you're going, oh my gosh, that's awful. They don't even have a dollar. Well, the standard is you would like to have a dollar of liquid assets, but it may not be normal for the industry. If you look out to the right, there's a little red. It says the industry is 90 cents. So they're in line. So if it may be difficult I don't even want to say that. They're in line with what the industry is normal for. Will all their current liabilities become due and they would have to immediately pay them? No. But it's a test to make sure we are in line with the industry. Now, there's other companies. Google is at $4.97. So they keep very liquid assets. Samsung is $1.71. But the norm is 90 cents. So they're okay. So even though it's not a dollar, don't sit there and write them off. Accounts receivable turnover. So current ratio, asset test ratio is measuring how well the company could pay their current liabilities with current liquidity, we call that. How liquid is the company? If they could pay their current liabilities with their current assets and they're in line with the industry, then they are considered to be liquid. Accounts receivable turnover is starting our next set of ratios that measure efficiency, how well the company manages major current assets. Accounts receivable is a major current asset. Now, how do you manage them? You collect them. So the first ratio is called the accounts receivable turnover. And the way we determine that is we take net sales from the income statement and divide it by average balance of accounts receivable net. Net meaning after you subtract your allowance for doubtful accounts. Sorry. Now, how do you determine average accounts receivable? Well, that's what's below. You take your beginning balance of accounts receivable at the beginning of the year, plus the ending accounts receivables at net, and divide that by 2. And that gives you your average. So they did that for Apple in our book. And make sure you can do that calculation. And it comes up to be 13.6 times. Now, what does this mean? It's telling us how many times the company collects on its accounts receivables during the year. How many times they convert the balance in accounts receivables into cash, which is so important because an amount sitting in accounts receivable can't be used. Cash can be used. So the more times we're able to convert, the more cash we'll be able to use. Now, the industry is 5. That's the average for Apple. So Apple does a great job on collecting their cash. Everybody else, their competitors, on average collected 5 times a year. They collected 13.6. Nice. So whatever they're doing, they keep doing. Now, I'm going to skip this one and go to this one. It's called day sales. Uncollected. I don't like the word uncollected. It sounds like you're not collecting them. Okay. I call it day sales collected, but your author calls it day sales uncollected. How do you get that? Well, you could take accounts receivable net divided by net sales times 365. Or how I get it, take 365 divided by your accounts receivable turnover. So either way, you should get the same answer. I'll just grab my calculator here really quick. So 365 days divided by how many times your accounts receivables is collected during the year. Yeah. Their number is just a little tiny bit higher. Okay, so let's stick with what they have. So take your current accounts receivable balance. I just go about a little bit differently. I get the number just a little bit different. Take the balance in accounts receivable at the end of the year, divided by your net sales, times that by 365 days. And it tells you basically how long it takes the company so frequently, how many days it takes the company to collect its accounts receivables from the day of the sale to the day they ultimately get cash. So it takes them about 28.5 days to collect their accounts receivables, and that's calculated on page 624. Now, for other people in their industry, Google 60.4 days. They wait almost 2 months to get their money. Whew. Samsung, 48.5 days. Yikes. I don't see an industry average here, though, for that. So we would have to see, there has to be an industry average. I think it's just a typo in your book, but I didn't read through all of it. Wow, that's crazy. So they're doing something right. Now, oh, and by the way, before we go on to the next thing, that is an important number even for the finance people in a company, because they use that to predict cash coming into the company. So they could say, okay, we made sales today. We normally collect our cash within 28.5 days. So we can expect that money on this day and project cash flow. The next asset that needs to be looked at and determine how well we manage it, if the company sells it, is inventory. So the first thing we calculate is what's called inventory turnover. And we determine that by taking cost of goods sold for the year divided by average inventory. Now again, average. So you're going to take beginning inventory plus ending inventory and divide that by 2. So this is illustrated on the bottom of page 623. So the cost of goods sold for Apple is $141,048. I'm getting that from their financial statement on page 620. And their inventory on page 619. Beginning of the year is $21,32. End of the year, $48,55. Divide that by 2. It's that average that's divided into cost of goods sold, and they get 40.4 times. This is how many times the company sells out its inventory on average during the year. So this isn't saying how long a company holds its inventory, and that's incorrect. It's telling us how many times they have to replace it, turnover. So that slide is incorrect there. How many times it takes, or how many times we have to basically replace our inventory. They replace their inventory 40.4 times. So that means on average, they're selling out their inventory 40.4. The average for the industry, guys, 7. So Apple knows how to sell their inventory, don't they? They're very good at it. Now, day sales and inventories is kind of like day sales uncollected for accounts receivable. We take the ending inventory balance divided by cost of goods sold times 365 days. This tells us how long it takes us to sell our inventory. Okay, so it says this ratio is useful for measuring and evaluating inventory liquidity. So from the day of purchase, it takes us 12.6 days to sell it at Apple. The industry normal, guys, 35 days. Now, Google sells in 6 days, Samsung 70.5 days. But that's what it's telling us. How many days it takes to sell out the inventory. Now, in your book, this is a great sentence. It's right above that formula. If all of Apple's sales were credit sales, the conversion of inventory to receivable in 12.6 days, plus the conversion of receivable to cash, 28.5 days, implies that that inventory balance will be converted into cash in 41.5 days. Another useful tool for us in the finance and accounting area, but also it's a great tool for showing how efficient the company manages their accounts receivable, which is our conversion to cash, and the inventory, which is converting an asset into a sale. So if you assume that, start with inventory. So we buy inventory, convert it to a sale. If that goes on account, now we've got to convert that into cash. Putting those two ratios together will tell us how many days it takes to convert a purchase into cash. Great, great efficiency measures. The final ratio in this building block of liquidity and efficiency is called total asset turnover. We measure that by taking net sales for the company. So that's what a company produces using their assets. All the asset use is to make sales. Divide that by your average total assets then. So how much money is invested in these things we're using to make sales? We find average total assets by taking total assets at the beginning of the year plus total assets at the end of the year and divide that by 2. So you could see Apple's on page 624. So their total sales for the year were 229, 234. And then we find the average total assets. Be careful, it's total assets you're finding the average of. So 0.66 times. So for every dollar in total assets, the company makes 0.66 cents in total sales. Not 0.66, but actually 66 cents in total sales. So it's measuring how well the company uses its assets to make sales. Now, what is the industry average? It's 1.1. So they're not using their assets as efficiently as their industry, but Google's is at 0.61, a direct competitor, and Samsung is at 0.85, all benchmarks. So are they operating in the range? Yes, but they're not at the industry. So maybe this is something they want to look at. So those were our efficiency ratios. Solvency. the next set of ratios. The key ones are the debt ratio, equity ratio, debt to equity ratio, and times interest earned. Remember, these are measuring the ability of the company to pay off long-term or overall debt. Can they do it? And if they can, that means they'll continue to operate and be solvent. Now, the debt ratio was already calculated in our vertical analysis, as well as the equity ratio. So the debt ratio shows total liabilities as a percent of total assets. So that is the formula: total debt over, or total liabilities over total assets. And that's on page 627. And also, do they show it separately here? Yes. Well, they don't, but that's how you get the debt ratio. So that's showing you what percentage of your assets, Apple, you still owe on, 64.3%. So the equity ratio shows us what percentage of the assets are actually owned by the company, because it's the owner's money that purchased them, 35.7%. Now, you have to look at your industry norms. The industry norm for debt ratio is 35%. For equity ratio, it's 65%. So we're a little backwards there. Okay, a lot backwards. So they invest, so they're not as solvent as their competition. That could hurt them. The debt to equity ratio takes total liabilities over total assets. I'm not a big fan of this one, but this ratio measures what portion of a company's assets are contributed by creditors. A larger debt to equity ratio implies less opportunity to expand through the use of debt financing. So for every dollar of equity, there's $1.80 in liabilities. The industry average is 0.6. We've already talked about this. Apple is very leveraged. So it has a lot more in debt that has purchased their assets than equity. It may explain why in the notes to the financial statement. So we don't go, oh my goodness, they have a terrible debt to equity. Oh gosh, they're gonna fail. We don't do that. We're identifying and trying to determine health here. Just like when you go to the doctor, if your blood pressure is high, he doesn't look at you and go, you're gonna die. No, we're identifying health and unhealthy and trying to remedy it or find out the reasons why. And then make an assessment. Then once they look at everything about you, then they can assess, are you going to die or not? I mean, that's pretty morbid, but that's what we're talking about here. Not one little thing will define the health of a company. Times interest earned ratio. We take the income before interest and taxes off of our income statement. So we got to be careful there. We want to make sure net income is our starting point. Add back your interest expense that was subtracted to get to net income. Add back income taxes. So if you go to Google, I keep saying Google, if you go to Apple's on page 620, you're going to take 48,351 plus 15,738. I don't know if they have interest separately here. You should have some interest. They've got a lot of debt. They might define it for us here. Maybe I'm looking at it. Well, we would need to know Apple's debt, their interest. But you would need to find that on the income statement. Their interest expense for this time period is 2323. So we add that back. Then we divide by 2323. Now, what does this tell us? It's telling us if the company makes enough in operating income for the year to pay interest expense. or how many times they could pay interest expense with their earnings, because that's where they're getting the money to pay the interest expense. They can't go out and borrow from creditors or the owners to pay interest expense. They have to be able to make it through their operations. So the more times a company could pay their interest, the more likely they will. So Apple can pay their interest 28.6 times from their normal operations. So it appears that they'll be able to pay off their debt. Now the competition's, Google's 250.5 and Samsung is 86.7. Now the reason for that is, though, you have to remember, is because they don't have as much debt as Apple. So you have to take that into account. Measuring our solvency, and in this case, Apple. Now, Apple's not as solvent as their industry or their competition. The next ratios measure profitability of the company. The first one is the profit margin. We already talked about that one. Return on total assets is another measure of profitability. And then return on common stockholders' equity. Let's take a look at this. Sorry about that. I keep having to take a little drink because my throat is getting dried out. Profit margin is determined by taking net income of the company divided by net sales. We did that in vertical analysis. So this is showing us how much of the company's sales or revenue remains as net income. Every industry is different. For Apple, 21.1%, and that's on page 625. The industry average is 11%. So they're doing much better than their competition when it comes to maintaining or keeping sales as net income. Net income is either going to be used to grow the company or pay dividends to the stockholders, or a combination of both. So the higher the profit margin, the more we like it. Now, some industries, they're very low profit margin. I was in transportation, I was jumping up and down if it was 8 or 9%. When I worked in broadcasting, the norm was 30%. So it all depends on the industry. Now, the return on total assets. Again, how profitable you are. So how well do you use your assets to make a profit? Okay, asset turnover looked at how well we use our assets to make a sale. Okay, but this is looking at to make a profit. So we're going to take net income of the company divided by average total assets. We already showed you how to get average total assets. And for Apple, it's 13.9%. So what does this mean? Well, think of it this way. The creditors and the owners gave money to the company, and the company purchased assets. So total assets are really the investment money given to them by creditors and stockholders. The company then used that money, bought assets, and used those assets to make net income. So net income is the return on those two groups' investments. If you're like, return on investment, what? Give me a word I can understand. It's like saying that's how much interest the company earned, interest income the company earned from that money. We're just converting that into a percentage. So they were able to make a return on this investment of 13.9%. Now, is that good or bad? Well, the industry normally only provides an 8% return. That's how well they use the assets to make net income. Samsung is at 15%. Google's at 6.9%. So it's converting the use of the assets to produce a profit into a percentage so that people can say, oh, they used my asset They use the money that I gave to them to buy assets, to produce a profit very well. The higher this return on total assets, the more growth there is in the investment overall. Stock prices will go up. The ability to pay dividends goes up. Now, in the next ratio, we only focus on money given to the company by common stockholders. How well do we use just their money to produce profit? Why do we just focus on them? Well, total assets focuses on creditors, preferred stockholders, and common stockholder money, because that's where all the money comes from to buy assets. Creditors already know their return percentage-wise because they define it when they create the loan. It's an interest rate. That's their return on investment from loaning money. Preferred shareholders already know their return because it's their dividend rate. That's the most they'll ever get from investing money into the company. So they already know theirs. Common stockholders, remember those cats? They get whatever's left over. So they don't really know how much profit is being generated using their money and how much they may be entitled to, percentage-wise. So that's what this ratio tells them. So how do we calculate it? Well, net income, remember, is the return or the money made for all shareholders. Subtract out the part that's already been promised to preferred shareholders, preferred dividends. So we're only isolating in our numerator the part of net income that was made, the profit that was made for the common stockholders. Oops. What am I doing? I'm going the wrong way, sorry. I was right in a good spot too. Okay, so that's what's in our numerator. Now divide that by the average money provided to the company from the common stockholders. Now, this is on page 626. Apple doesn't have any preferred stockholders. So it's net income minus 0, and then take their stockholders' equity, beginning of the year plus end of the year, because all of their stockholders' equity is common stockholders' equity, divided by 2, 36.9%. So here's how you can think of it. If Apple was a bank, the common stockholders invested their money, Apple would have paid them 36.9% interest this year. That's how well Apple used common stockholders' investments in the company to generate a profit. Now the norm is 15%. Samsung generates a 20.5% profit using common stockholders' investments. So it looks like our people at Apple are doing a great job, and that's reflected in their stock price. They know what they're doing. So those ratios, again, help us define how profitable the company is by how much of a profit they actually keep from their sales and how well they use the money that's invested in them to make profit. Those percentages measure that. The last two ratios, or three ratios, they don't give us the earnings per share. Well, we did talk about it though. Market prospects. We have price earnings ratio and dividend yield. So this is really showing us how well the company performs. Okay, and overall, how much of a healthy or not healthy investment this may be for someone who's looking to buy the stock. The first one is the price earnings ratio. You also hear it referred to as the PE ratio. And we determine that by taking market price of the shares divided by earnings per share. Remember, earnings per share is how much one share of how much profit the company makes for one share of common stock. So we divide those out. And this is just so cryptic, this message here. Measures market expectations for future growth. Well, here's how I look at price earnings ratio. And if you see Google's, can I do it again? Yes, Apple's, it's 16.6. Here's how you can look at that. For every $1 of earnings per share, so for every $1 the company was able to make in earnings per share, the value of the stock is $16.6. Another example. Let's say the company came out. Now, Google's earnings per share, Apple's earnings per share is $9.27. Let's say a few months ago, Apple came out and said, we expect our earnings per share to be $8.27. The stock market reacts to that. Because remember, going in, a common stockholder doesn't know how much earnings there are for one of their share of stock, because it's the earnings that they may get paid as a dividend. So you can look at earnings per share as the maximum dividend for one share of stock in a year, if all of the net income was declared and paid as a dividend. Now, the market will react. A couple months later, earnings per share comes out to be $9.27. Awesome. What do you expect to happen to the price of the stock? It's going to increase. It's going to increase. You expected $8.27, it comes in higher at $9.27. So you're making more per share. The earnings are more per share than expected by $1. So how much do you expect the stock to go up? $16.60. That's what we mean by you could project future growth. So that defines a lot about the market prospects related to the stock. Dividend yield is our other ratio, and that's measuring how much are they actually paying in dividends, the company. So they take annual cash dividends for the share of stock and divide it by the market price of the stock. Think of it this way. You buy a share of Apple stock today, which I'm not sure what it's trading at. It's usually very high, maybe $250 a share. Okay, and the annual dividend is, in this case, there it is. We'll use their shares information here. The annual cash dividend Apple is currently paying is $2.40. If you buy a share of stock today for $154.12, how much of an actual cash return are you getting on that stock? 1.6%. So if you want to buy a share of stock that's giving you a 2% return or dividend yield, you won't buy Apple, because the dividend compared to the price of it today only allows you a 1.6% yield on your investment. So it's just telling you the percentage, how much money you'll get back this year as a dividend based on the market price. Now, Samsung is also at 1.6%. Google, 0, because they probably don't pay a dividend. Okay, so not all companies are going to pay a dividend either. So those are all of our tools. Now, these ones, again, we're measuring market prospects. So now there's all of the various ratios that we use and what they tell us. So how do we fit this all together? We look at everything. Again, we look at summaries of information, executive summaries from our financial reports. We look at all of our analysis and where it was positive and where it was negative. We look at other evidential matter that may give us information about the company. We look at assumptions, key factors, and even inferences. And I'm not going into that. What does all of that mean? You have to look at everything. And depending on why we're analyzing the financial statements, we will focus more on one thing over another. Let me go back here. So if we're just inside the company going, how healthy are we? We may need to look at maybe more evidential matter when we find a problem area. Find out why. What can we do to fix it? Okay. If we're on the outside looking at something going, boy, they don't seem as healthy as their competitor here. Why is that? Well, let's see what kind of assumptions they make. Let's see what kind of accounting principles they use. Maybe that's why. Maybe they use LIFO instead of FIFO like their competition. Okay, so we're not saying, we can't sit here and say at this point that you can do 100% analysis and be correct. Okay, because it's an art that you'll get as you get more experience with it, you will get feels for things, and it's just like anything else. When you start something like, I don't know, like horse racing popped into my mind. Like the first time you go and bet on a horse, you might have the tools, but you might be like, well, I need more experience with it to get really good at it. Okay, maybe that's not the best, but same with the doctor thing, the more experience we have, the better ability we have to do this analysis. What we want to do here in this chapter is let you know, these are all the tools you'll use. You go beyond the tools also and look at assumptions and other key factors related to the company. Look at as much evidence as you can, and then look at everything and make your decision on the health of that company, your final analysis. Okay, so I know my next slide is the appendix, but you're not responsible for the appendix. So I'm going to end our discussion here. Please post any questions you may have to the discussion board.